I'm going to go ahead and share my screen here. And this is what we're going to be covering, which is everything you need to know before purchasing an investment property. So I'm Shannon with the Shannon Jones team at Keller Williams Realty in Long Beach. And I've been selling real estate in Long Beach and surrounding communities since 1998. And our team focuses on assisting people with buying and selling property in Southern California, both residential and residential investment properties. Joining me today and leading most of the discussion for our team will be Brad Jones, who is my husband and business partner. And he actually works with most of the investors that our team represents. We've also got joining us, Julie Aragon, who is a local lender, and she's going to be speaking about how to get financing and what you need to know about that. And then, because we do have a number of people who are looking to invest elsewhere beyond Southern California, we have invited a couple of real estate agents who are very successful and working with a lot of investors in some other areas of the country. So we'll have Merrill Jencks from the Phoenix, Arizona area, and also Micah McGahan, who's in Oklahoma City. And we'll be talking about how, if you're thinking about someplace other than Southern California, would you evaluate that and how would you get started? And then last but not least, we will also have Kevin Kelly from Orange Coast Title. And I have known Kevin for many years. Kevin and I went to college together. So that was just a couple years ago.
Just a couple.
Yeah, just a couple years. Of course, I did tell you I'd been selling real estate since 98. So you may have figured out that wasn't a couple of years ago. Anyways, so getting started here. Let's talk first about the types of property that you could consider purchasing. And we'll have Brad talk about that.
Okay, so thanks for joining us. And this will be everything you need to know in an abbreviated version. So we're just going to talk about the general types of investments and answer all your questions. But just to look at these things here, what types of investment properties can you look at as a first-time investor or even a more experienced investor? Residential investment property is what most people think of when they're making their first investments. They have a rental home or a rental condo, maybe a vacation home, something like that. That's usually 1 to 4 units. So you could have a single family house, duplex, triplex, fourplex. They can be condos, they can be townhouses as well. Typically, they're all residential units on one parcel. So you're having a single property, though you might have 2 or 3 quote unquote doors on that property. You can also have commercial investments, and those would be, if you're in the residential realm, it would be 5 units and up. So those are handled differently than typical residential investment property. The financing is a lot different. Those are usually larger apartment buildings, things like that, or maybe just a 6 to 8 unit complex, something like that. That could also incorporate retail, office buildings, warehouse, things like that. So strictly commercial properties. And then you might get into a mixed use property. You might see an office building with a couple of small apartments behind, or a retail shop with some apartments above, things like that. Those are mixed use, and requires a little bit more management and expertise, if you will. Something to think about. But those are just in general the types of residential or investment properties that you can invest in. Okay. So when you're starting to think about investing, what are your goals? You have to give a lot of people just think, oh, I want to invest in real estate. Well, what are you investing for? What are your long-term goals? What are your short-term goals? Is this to help you establish a retirement plan and build some equity? Do you need some immediate cash flow? All of those are things that you need to think about when you're determining your own personal goals for the property. What can you do? You can buy and hold property. Again, that's probably the most common way for a new investor to get involved. They buy a property, they rent it out, and they get a little cash flow, and they let the property appreciate and get some equity growth. You can buy and sell. Now, a buy and sell, you don't see too much of people buying it and then immediately selling it unless you find an amazing opportunity. More commonly, you're hearing things about buying and flipping. That's where somebody buys a property, they rehab the property, and then they put it back on the market for a profit. Okay, that requires a little bit more resources and expertise and knowledge of the market. So what are the pros and cons? Well, the buy and hold, a little less maintenance, a little less management maybe. And once you've put a tenant in place and your property's in good shape, it might just be a cash flow opportunity for you for years. And unless you have turnover in tenants, it's pretty easy to manage, and maybe you do it yourself or have a management company. The buy and flip is where I think most people think about, because they hear a lot about it in the news and in the market.
And on HGTV.
And on HGTV, yeah, everybody on HGTV wants to flip a house. And it might work well if you have the market knowledge, so a good local realtor to help guide you in the initial purchase. I think I found that most people who don't do well with with flipping homes, they didn't buy it right in the first place. They spent more than they should have, and they didn't account for what's it actually going to take to rehab this property. So they might not have the contractor connections, and that's what's important. Contractor connections or experience in the industry, knowledge of expenses. If you have some background in that or family background in that, that's great. And it takes time and energy. Do you have the time to commit to, flipping a house, being on site, managing the contractors and the process? It can be a long-term process. The hard thing right now, honestly, in our market, and probably in Merrill and Micah's markets as well, is it's finding the opportunity in the first place. And if you can, then great. But I think probably for most first-time investors, a buy and hold strategy is great. Okay.
And I will say too that we have a lot of investors always approaching us wanting to know about off-market opportunities that would work for flipping. And we have a database filled with people who want to do that. And while that is the more, sexy type of investment, I think long-term wealth can really be maybe better achieved by buying and holding long-term, because you're allowing the property to do a lot of that work for you with the appreciation. So just another perspective there. Did you have anything else you wanted to add in terms of pros and cons? I think you kind of went over them.
No,
Yeah.
that's pretty much it. I think the just being aware of your own personal situation and your own abilities. Flipping a house requires resources, not only in expertise, but also in capital. You have to have the money available to put into it. And if you don't, do you want to do hard money financing, which is short-term construction financing? Now you're getting into a whole nother level of conversation. So
I'm going to do real quickly. I'm going to, before we go into this next thing, I'm going to, and I don't know where it will come up, but if you all can see a poll, I've launched a poll. So if you all see a poll pop up, there's just a couple questions. There you go. And so I'm just curious about how many people actually currently own investment properties, and how many people are interested in purchasing investment properties in this coming year in 2022. So right now we've got 8 people who have responded. It's kind of cool. I'll give you this. 9 people have responded. Right now, it looks like of the people who are participating, who have responded, we have most of the people who are on here right now don't currently own investment properties. So right now, 82% of the people who have joined us right now do not currently own investment property. And it looks like of the people who are on here, this should not be a shock to me, but 100% would like to buy investment property in 2022. So we are very glad that you joined us. And I'm going to just end this poll, and Brad's going to keep going on what you need to know before buying.
okay. So what do you need to know before buying? Down payment requirements. I'm not going to go into a lot of this. I'll let Julie cover this in a few minutes. But they do require, if you're non-owner occupied, it requires a larger down payment. You can still get into investment properties if you wanted to live in one unit and rent the others, perhaps in a 2, 3, or 4 unit property. Again, I'll let Julie go into the details of that financing. The rehab costs, we've talked about this just briefly. I just want to cover it a little bit more. You know, if you're buying a property to buy and hold, how much work is needed to make it rentable, to make it meet, you know, minimum conditions? Is it just paint, flooring, cosmetic stuff, or is it going to require a bigger investment to get it ready to rent and be in good shape for the future? The rehab costs we talked about for flips, but just keep in mind material costs are going up at an astronomical rate right now. So the costs for flipping a house can be hard to determine and hard to get a real handle on sometimes if you don't have an experienced contractor or that industry experience. So keep that in mind. And if you do rehabs to flip, please keep in mind doing things with permits is always a good idea. We've run across a lot of times when people have, you know, wanted to improve a property and then they didn't pull the right permits with the city, and then an appraiser can't give something value that they thought they would be getting value for. So talk to your local realtor, whether it's us or Merrill or Micah or wherever you're looking, to get some specific advice about different areas. The location, where do you want to buy? Do you want to buy your first property in some place that you can drive to, visit on a regular basis? Shannon mentioned it earlier. Is it someplace that you would visit to see family or friends or vacation or potential retirement location? You know, is there a reason to go where you're buying a house? Because if there's not, you might not be in the right location, honestly. You want to make sure that it's someplace that it's easy to get to, and that as you're building your investment portfolio, if you buy more than one, you might not want to be scattered in multiple locations. You might want to focus on a particular area. And then the criteria for the property. Have a clear idea of market value. Again, talk to us, talk to your realtors, to make sure that if you're buying the property, you're buying it right in the first place. Again, that's where I see most of the mistakes made in investments, is people get into the multiple offers and the quote unquote bidding wars, and they end up paying more for the property than they might have. So keep your businessman hat on. Have a real clear idea of what price will work for you. Condition, we've talked about. Be sure you're comfortable with the condition of the property. And again, keep in mind the long-term goals, whether it's cash flow, money from a flip, equity growth. You might be happy breaking even on a property if you know it's going to appreciate in value over time, if it's a 10-year investment for you, something like that. Okay. Why invest in 2022? Interest rates are going up. We're seeing they've been going up over the last few weeks. And as you've heard in the news, they're expected to continue to go up this year. The Fed is going to raise rates 2 or 3 times this year. And the mortgage market's already taken that into account a little bit. And again, Julie can talk on that a little bit as well. Price appreciation, depends what market you're in. And even within certain markets, they're different in different neighborhoods. But prices are expected to continue to appreciate. Maybe not as rapidly as they did last year. The rising interest rates might slow that rate of appreciation down, but property is still expected to go up. So why buy now? Well, lower interest rates. And if you can get in now, the market goes up for a while, even if the market corrects, and the market will correct, it always does. It might not correct back down to the point where we are now. Okay. So there's the opportunity to get in while the prices relatively are going to be lower than they will be in the future. And the interest rates, I don't know that they're going to go back down again. So now is a good time. And the rental demand. The prices of homes are going up. That's great for those of us that can afford, afford to invest, but not everybody can. And everybody needs a home. There's a huge rental demand. It's vacancies are hard to find. So getting into an area where there's good job growth, good economy, make sure when you're buying a property that you know where your tenants are going to come from. Buy a property and kind of have an idea of who's my ideal tenant for this property. I think Merrill mentioned to me when we were talking before about a car manufacturer that came into his local area. That's great. There's good paying jobs for people, and they might not be able to afford that house yet. Okay. So keep that in mind. Okay.
So when you're evaluating properties, you will see some investment terms used pretty commonly. And so Brad's going to review basically what are the definitions, just simple definitions for these terms that you might see. If you want to set up a time to go over this in more detail, we can, but this is going to be overview.
Okay, so these investment terms, again, I just want to touch on them so you can recognize them. If you see them come up and you wonder what's that, these are all ways to evaluate investment property. How do you compare one property to another? How do you compare a single family house to a 4-unit apartment building? How do you evaluate that and determine which is the better investment? Well, net operating income, that's just like with any business, the income after all your expenses. Cap rate is a term that's specific to real estate, and it's a formula to help evaluate and compare different investment properties. Again, a single property, maybe a 4-unit building to an 8-unit building. It's really the operating income divided by the purchase price. So what's good? A higher cap rate is better, and every market is different. And even within our area in Long Beach, it's different than it is in certain areas of Los Angeles. And I know Phoenix, Oklahoma City, other places, it's going to be completely different as well. The gross rent multiplier, that's just the sales price divided by the income. It's really how many years will it take to pay off that loan, excluding all the other factors. Again, it's just a real quick, down and dirty way to evaluate the property. The operating expense ratio, that's again, now you're getting into the details of what's it take to manage the property, all the expenses, everything relates to the net operating income. But really, cap rate and gross rent multiplier are the terms that you'll probably most commonly hear. And we can go into the details of how you evaluate those another time if you're interested. Okay.
All right.
All right.
So, how will you finance your investment? If you've got unlimited piles of cash, awesome. Go buy whatever you want. That doesn't apply, however, to most people. If you do have that, please see me. But for the rest of you, you will probably need a lender. If you are buying a single family home or a condo or 2 to 4 units, you'll need one type of lender versus if you're buying 5+ units or a retail or some other type of a commercial establishment. But what you're going to want to look for, regardless of the type of lender, is someone who is experienced and knowledgeable and reputable. And so we are going to have a lender who meets all of those criteria right now and talk to you a little bit about getting financing. And again, here is Julie Aragon to talk more about some of the things you need to know.
Perfect. Well, thank you both, Shannon, Brad, and Shannon for having me, because small multifamily is very near and dear to my heart. I've been investing in small multifamily for about 10 years now, and it's just provided a lot of opportunities for investing and creating wealth. So I want to go through a couple points. What is the lender looking for? So plain and simple, can you pay the loan back? Okay, so similar to if you're going to buy a property that you're going to live in, they want to make sure that you can afford this property. And typically, they're looking for ratios under 45%. So what that means is if you make $10,000 a month, your housing payment and any other debt can't be over $4,500. Okay. The good news is when you're looking at, let's say, a duplex, you can use 75% of the market rent on that second unit to help you qualify. So that's really good news. As far as down payment, so it's going to vary depending on what you're looking to do. One of the first properties I got was a duplex a long time ago, and I put 3.5% down. At the time, it was just my tax person said, Julie, you need a write-off. And it wasn't in the area that my dream neighborhood, but it was a property I could afford. And with that second unit allowed me to get into something. So the minimum down for FHA is 3.5%. These days for a duplex, you can buy up to 1.85 purchase price with just about 40,000 down. Good news is 100% of that can be a gift. So if you've got a very generous relative, maybe one with some lazy equity in their home, and they want to gift that to you now so you can start building wealth, FHA is a great program to do that. The other option is conventional, which will require a little bit more down. Minimum down on a duplex is going to be 15%. And again, you can go up to 1.2 loan amount. So that's going to be in like the 131. Oh, and I'm sorry, I'm talking about Los Angeles County. So those loan limits will vary for Micah and the other gentleman. So anyway, conventional 15% down. If you're going non-owner, so if you don't intend to live in the property and let's say you already own your own primary, the minimum down is going to be 25%. Okay, so it does require more down, and the rates are generally higher when you're going non-owner. Documentation, so similar to if you're getting pre-approved to buy a home, the lender is going to want to see tax returns, W-2s, pay stubs, everything just to show that you can afford the property. So unlike commercial where they're looking at the building, with residential, they're looking at, can you afford to pay the property back? So they don't care maybe that the property, the current market rents or the current rents are under market. As long as you can afford the loan, you can get it. And then we're also going to want to see things like your mortgage statement for your current housing expense, things like that. The process is to reach out to a lender, like Shannon said, look for one with a good reputation and a track record, and just start talking about your options. You can go through the different minimum down payment, look at maybe projected, once you have a local realtor, they'll be able to tell you projected rent so you can see if it's something that you can afford. And then figuring out the down payment. So like I mentioned, there's a lot of lazy equity these days. There's equity that's trapped in the home and maybe not earning a rate of return. And if you can tap into some of that and use that and buy another property, then that you're really going to start to build generational wealth. I'm a big fan of buying and holding because I'm not skilled at flipping.
Well, and I really think that is what really does allow you to build more equity, because you get to keep the property and somebody else is paying it off for you.
Oh my God, Shannon, that property that I put 30,000 down is positive $1,500 a month. I refinanced it into conventional years ago. It's $1,500 a month positive, and I mean, it's the best thing ever.
Yeah, absolutely. And I think, a lot of people now don't work in these companies where, you have a massive pension or something. And let's face it, none of us is probably really counting on Social Security to retire in a manner to which we would like to become accustomed. And so buying investment properties that will have positive cash flow is one way to really look at funding your retirement. So it's definitely something to look at. Okay. So if anybody has any specific questions for Julie about financing, we are going to do a Q&A at the end. So I did have one person asked a question about wanting specific formulas. If anybody else wants them, we can email out some of those specific mathematical formulas on the terms that Brad reviewed. So if you have a different email address that you want it to, make sure we have it. Otherwise, we'll send it to the ones that we had. I'm going to skip to the next slide. We don't have the commercial lender who is going to join us, and Brad is going to go over a little bit of this. But the big thing that you should know is the real difference between financing anything 4 units and under and financing something that's 5 units plus or another type of commercial property is that in addition to you qualifying, the property needs to qualify. So Brad will go over this just super briefly. And if you do need a referral to a great commercial lender, we can absolutely put you in touch with one.
And like Julie mentioned, this doesn't, with commercial properties, if you're getting below market rent, that will affect your ability to get financing. So the property qualifications you'll see here, can the property cash flow independently support the debt? Will this property pay for itself? Okay. The lender could get into more detail about how much it needs to cover and all of that. You still, as a borrower, need to qualify and have a minimum net worth and things that Julie doesn't look at as closely, or she looks at differently than a commercial lender does. Loans are different for commercial. They're shorter term. They typically move into an adjustable rate loan. You don't get a standard 30-year mortgage on an office building, for instance. And they can get creative. Julie can get creative too. Talk to her if you have specific situations. But the commercial lenders can get creative with the length of the loan, the pre-approval, or the adjustable rate, excuse me, all of that. So again, without getting into too much detail, just know that the bigger the property, or if it's commercial, the property kind of needs to stand on its own and finance it and be able to cover the mortgage. And then you also have to have enough financial reserves to satisfy the lender's requirements. That's all I have on that.
Okay, thank you.
And if you need the connection or the contact info for a commercial lender, let me know and we can put you in touch with them.
Okay. So once you've looked at the financing, one of the things that you see is, as Julie said, there's some amazing opportunities if you want to buy a property that is kind of doubling as your residence and an investment. But if you're buying something non-owner occupant and you're purchasing it strictly as an investment, you do have to put 25% down. And so for many people, that 25% down has become a hurdle here in Southern California because our prices are higher than elsewhere in the country. Well, not everywhere else, but than many places in the country. And so if you're thinking of buying someplace else, what are the things that you should consider? So this is a list that was put together by Quicken Loans. These are some of the places that you might consider. Obviously, there's many, many more. But some of the things to look at are, what's the economy? What does the job growth look like? What about population growth? Are you looking in a market where people are moving there or where everybody's moving away? What are the current home prices? What are rents? And then you might look at, do you have any connections to a particular location? Do you have family that lives there? Is it a place you like to go? Do you envision yourself maybe retiring there? Maybe you purchase a property that is an investment now, but perhaps down the road, you might convert it to your retirement home. And then you can cash out the equity on your property in Southern California. So there's lots of different things to consider, but these are just some of the places in the country where you can see median prices are far below here what they are in Long Beach or other surrounding communities. And yet the rents are all still pretty reasonable. We took a look at, so we sometimes will have people come to us and say, I really want to buy an investment property and I have, $40,000, $50,000 to put down. So at 25% down, that would take somebody to about $200,000. And here in Long Beach, we could maybe find you a studio condo without parking that's sort of run down in a very dense area. And yet, in many parts of the country, for $200,000, you can buy a house. And this gives you an idea in some of these locations what you might be able to get. So you can see in Oklahoma City, in Phoenix, Arizona, Jackson, Tennessee, Pocatello, Idaho, or Houston, Texas. You're buying an actual house and it has a reasonable rent. And so when you pencil things out and you figure out, yes, you're going to have to pay some maintenance. You're going to have to factor in vacancy rates. You're going to probably want to factor in property management costs and all of those things. And yet it is possible to generate a positive cash flow from properties in some of these areas. And so as a team, we actually have a number of amazing real estate agents who we have connections with around the country, actually around the world, but more around the country. And so if you say, I'd like to invest in El Paso, Texas, we can connect you with an amazing real estate agent there who can then also connect you with a great lender and a property management company and help you evaluate what would that property rent for. So if you specifically have an area in mind, definitely reach out to us and we can be a great resource, even though we're based in Long Beach. So we're very fortunate today to have two amazing real estate agents from elsewhere in the country, where you do still have some opportunities to buy properties that would produce positive cash flow for a little bit less initial capital investment. And so the first person that we're going to have talk to you is Merrill Jencks, who is from Phoenix, Arizona, and he's going to share a little bit about what you can expect with the market there.
Excellent. Thank you very much for having me, Shannon and Brad. And hopefully I can share some helpful information with you all today. So in Phoenix, of course, just like everywhere, our market has been pretty crazy lately and home prices have gone up a lot. So like in Phoenix proper, it is getting harder. Median home price is at $435,000. The average rental price is $2,243, which is a little different than the Quicken Loan slide, but I ran those numbers just recently. So rents have risen 20%.
We believe you.
Yeah, rents have risen 20% in the past year. So, sometimes they're down. But anyway, a couple of great reasons to invest in Arizona. Arizona is one of the most landlord-friendly states in terms of very easy evictions and very easy and fast. You've got a tenant who's not paying or something like that. You can move on from them very, very quickly and get them out of the house and re-rent the property to somebody else. Not to say that we're just constantly dealing with evictions. We deal with a ton of rental properties, and very rarely are you dealing with evictions. So I don't want to scare people, but as far as I'm aware, it's much safer than what you might see in terms of evictions in California, as an example.
It's a different environment for sure.
Yeah.
One of the things in California that does have some investors looking elsewhere is that there are a lot of protections in place for tenants, and it is not as landlord friendly as some other locations.
Yeah, exactly. And there's also like I've heard, no California expert, but there's putting ceilings on how much rents can raise, and maybe there's other stuff and talk about that kind of thing passing. There's nothing like that here, so you can raise the rents according to the market. Also, we have one of the lowest property taxes in the whole country. Average taxes are about 0.7% of a property's value, but even that's a little high lately with how fast prices are rising. The county assessor is years and years behind, so probably closer to 0.5% in most cases is what you're going to see. And on the outskirts of town, so not in Phoenix proper, but go out into the more, far suburban areas, there's some really great opportunities. My favorite recommendation for investors who come to me right now is actually new construction that you can get for $220,000 to $250,000, and it rents for $1,600 to $1,700 a month, depending on the floor plan and which community you go in. So really, really nice cash flow, especially if you're putting 20 or 25% down. And what I love about it is, you're not going to have to deal with new roofs and putting in a lot of investors coming up with the 20% is hard enough, right? So you don't have to come up with renovation costs on top of that. And I just think it is probably one of the most perfect ways to start if you're a first-time investor. I'm just totally turnkey, get a tenant in there, start getting cash flow, and then maybe try something more complicated on your second one.
Great. Awesome.
Okay.
So we will have an opportunity too, if you have any specific questions for Merrill at the end. Thank you, Merrill.
Yep. Thank you.
So next up, we have Micah McGahan and from Oklahoma City. And full disclaimer, Brad and I are in escrow to purchase a house in Oklahoma City, and Micah is the agent who's helping us there. And one of the reasons, no, we don't have plans to retire to Oklahoma City, But we do have, Brad has a lot of family that's there. And one of his family members has a number of investment properties there. And so we were able to tap into the resources that he already has in place. So a real estate agent who we can trust, as well as a lender and a property manager and a crew that can help with rehab. And so for us, that made that very appealing. But Micah's going to talk about some of the other things that make that an appealing place to invest.
Well, thank you guys for having me, and y'all been great to work with. So I'm glad to be associated with y'all. So Oklahoma City, it's been growing pretty fast. Since 2010, I think we are around 17.4% growth rate in our population. So it's been, I've seen it because I've been born and raised here, but I've seen it really grow. We recently became a top 25 city, which was kind of a big deal here because we were always kind of like a forgotten city, but we've kind of gotten on the map in the last little bit with the Thunder team coming here from Seattle. So that was kind of a big deal to our city. So I think what's going to happen is that growth is going to accelerate further as people realize like our cost of living and the purchase price of homes is extremely affordable. Like I think our household income average is around 55 grand for the average household, which equates to about a third of their income for rent. So that's a very good proportions for your rental pool of tenants. But you get a really nice house for around $250, newer construction, and it'll rent out for about $1,400 all the way up to $1,700 actually. And the house in that picture that recently closed at 205, and they actually got around $1,900 a month in rent for that house. It's more in a historic core area of Oklahoma City, but I thought that was a very good example of, a house you can get. It got a little higher than the averages, but you get some good quality housing at very affordable rates. Also, it's very landlord friendly. We have, I think it might take around 30 days to evict somebody from the time you post notice on their door on most circumstances. So very easy eviction process. Also, like our Oklahoma City's unemployment rate is like 1.6%, which is extremely low. And you can feel, you can see the jobs just going like crazy here. But that's a big overview of Oklahoma City. And some of the things that I see as far as what's driving the growth here, and then also why people are considering Oklahoma City over maybe some of the other markets. But that's my take on it anyways.
Well, I think your comment dovetails with what Merrill was saying. Comparing it to California, where we have eviction moratoriums and rent rate increase limitations and things like that, outside of our area, what would attract an investor looking to rent a property? Well, it's landlord friendly. In both cases, Arizona, Oklahoma, I think you're both in that situation. And I think what you're also seeing is the ratio of rent to purchase price is a lot higher outside of California than it is here. You can generate positive cash flow on a property in Arizona. You can do that in Oklahoma. And that's one of the things that attracted Shannon and I to Oklahoma was the very low purchase price, but that ability to have cash flow and equity growth. And that's going to be the case in Arizona, Oklahoma, and in a lot of those other cities that were on that list.
Right. So thank you so much, Micah. And if you find one just like this, I want it. So
Yeah, that one's cute.
that is. I'm not as concerned about the cute because I'm not going to live there. And yet, if it was cute too, that would be a big bonus. So
we might get y'all here after all.
No, I'm a Southern California person. I really am. So, but I might visit. So there you go. Okay. So thank you. Also, Micah. So how do you get started? there's a few things that you just want to kind of do. The first one is to establish your goals and think about short-term and long-term. What are you hoping to do? Are you wanting to build wealth, build equity? Are you wanting to create positive cash flow? What are those goals? And the second one is to determine, where do you want to invest? Do you want to invest where you live? Are you going to buy a place that's going to double as a residence and an investment? Are you attracted to some particular location? Do you have long-term plans that would take you there? Would you like to invest, for example, in Las Vegas and be able to write off your trips to go check on that investment property? So there's lots of different things to consider when you're looking at location. The next thing is to get pre-approved and determine your budget. How much do you have to spend? What do you have to invest initially? And you want to also, as Merrill pointed out, factor in not just that down payment and the closing costs, but if you're going to need funds to rehab it, then maybe new construction someplace will be an attractive option for you. And then connect with a lender to figure out what you are pre-approved for. And
I would jump in there and say a local lender, because realtors like to deal with lenders who are local to their market. So once you've determined, I want to be in Oklahoma City, or I want to be in the Phoenix area, check with your realtor there and let them put you in touch with a good local lender, because they'll have all those connections, and a lot of the other agents know those lenders. So very important.
Very, very important. Absolutely. And they're going to know more about the local market there. They're going to have connections with local appraisers. There's lots and lots of reasons to work with a reputable local lender. And you're going to want to have that lender and that real estate agent as part of a team. If you're going to be buying a property that you won't be able to manage because it's not driving distance from you, then you definitely want to have a property manager. And you want to know what is the cost for that property manager, so that you can factor that into your financial calculations about whether or not a property will work for you. Make sure you're looking at not just the principal and interest, but also taxes, insurance, management, upkeep. Are you going to need to hire a gardener? Factor that in. And you want to have that whole team in place before you go out and start making offers on properties. Let's face it, it is super easy to find properties online now. And yet, how do you evaluate if that's actually a property that's going to work for you? I am just like all these people that we work with, sending stuff to Micah. I found this one on Redfin. I found this one on this, and Brad sending, stuff. I'm just like that. And Micah says to me, well, Shannon, this area requires a resale inspection or inspection every time when a tenant moves out and another tenant moves in. Well, that's kind of important to know. I wouldn't find that out online. That's something that you wouldn't necessarily know if you weren't working with someone who was local to the area where you want to look. And that's why that's so important. And once you've got that team in place, then it's time to locate a property, and your team can help you evaluate whether or not that property will take you in the direction of your goals. And once you've got your offer accepted, you're going to figure out how to take title to the property. And to talk about that, we have Kevin Kelly from Orange Coast Title.
Hey guys, thank you for having me. I get the sexy topic of title. But let me just kind of mention that taking title in an investment environment is a little more important than it tends to be if it's your primary residence. So taking title, and I'm speaking about California, but there's a form of title in every state. Obviously, there's the traditional, you have two people, that's joint tenancy. If one passes, the other's share automatically reverts. All fine. When we see investment properties, we see more percentage divisions. So that means you're going in with community property as to an undivided. So let's say your parents and you want to buy a property together. They're putting in 50%, you're putting in 50%. Or let's say 60-40, that's easier. And so we determine using community property that we can delineate percentages everywhere from 2 to 98 to whatever percentages you have. And then we determine if you want to add rights of survivorship, which then means if something were to happen to one of the parties, it automatically goes to the other. We very rarely see that. In community property situations, particularly on the investment side, we really see my percentage 40 is in my trust. So my heirs will be dealing with it on my passing. And the 60% is in either another couple or maybe their trust. So that's kind of what we see more often in investment. I do want to talk about LLCs. So LLCs are a great tax advantage to buy investment property. Here are just a couple caveats to think about. One, once you have your LLC formed, which is really a relatively inexpensive thing, it is about, in the state of California, it's about $1,600 a month, or I'm sorry, a year, pardon me, $1,600 annually to the state of California to keep that current. And so you got to factor that in. If you're going to have an LLC, you got to keep that current with the state every year. Every so often we have a property where they've let the LLC lapse and they got to bring in an additional $8,000 to bring it current. It probably wasn't in your net sheet. You don't really love that. It goes to the state of California. We're not really sure what they do with the money, but the reality of that is it's a great product, but just know there's another cost there. And then here's one that I really am an advocate of, which is buying the property, or once you purchase it with a loan, putting it into a family trust. When it's your primary residence, family trusts are I always suggest them, but they're not as necessary in a marital couple kind of situation. Family trusts become really important, and particularly in California with the passing of Prop 19. And I'm not going to go too into that because this isn't really the environment for it, but you can definitely ask me questions because I do a talk on that too. But basically, they've set guidelines. So what used to happen is people had 3 children, they would buy 3 investment properties, and their plan for their kids were each one would get that property. That can still be done, but it needs to be done through your trust. And what I love about trusts is, in an ideal scenario, the trust stays the same for generation after generation after generation. Just remember, trusts can be amended on the back end all the time. Like I just had to do mine because at the time I did it, my daughter was 12 and my brother was the executor, and now she's a lawyer herself and she's 31 and my brother's passed. And so it was just so outdated. So, but normally trust attorneys include 3 amendments that are free with your actual trust creation. So those are kind of the things that I would be looking at. LLCs, getting your family trust done, again, more assets, more protections you want, and more directives. A trust is just the roadmap to how you want things to go once you're not around. And it's really simple. I think they run about $1,700 for just a general kind of average estate. And if you have any questions, please, I'm accessible through Brad and Shannon. And there you go.
Okay, thank you, Kevin.
Thanks, guys.
So one of the things that you also want to look at in terms of future planning, and of course, you're going to be looking at trust versus LLC. Once you acquire a property, what happens if you then make changes and look at acquiring other properties? And let's say you buy 4 units and now you decide to leverage the equity in that and buy 20. One of the things to be aware of is the availability of something called a 1031 exchange. We have done webinars on that in the past, and we may in the future. So make sure that you are on our e-newsletter and you're on our email list, and we'll make sure to invite you to that in the future, because we do have a great expert that we can put you in touch with on that. It looks like somebody had raised their hand. If anybody has questions or questions, hopefully we have answers. It looks like somebody's raising their hand, but I'm not seeing a question. So I don't really know how to.
I'm just going to while you're looking for that, I'm just going to make a
Perfect.
quick comment on this. And a 1031 exchange is just a way to defer capital gains taxes. So you can take the equity and money from one property, invest it directly into your next property. You don't touch the money. It's a great way to grow your real estate portfolio. In all cases, whether you're doing that or anything, even before you begin to invest, talk to your financial planner or your tax pro and let them know, hey, I'm thinking of, buying some investment property. What do I need? You need to make them aware so they can plan for your taxes, because it does get more complicated. Okay.
Okay.
That's that.
All right. So I don't see another question. If anybody has any questions, great. I see a hand raised, but again, if you want to add it to the Q&A, that's awesome. If not, if nobody has any questions, I want to thank those of you who joined us. Those of you who couldn't join us and are watching this after the fact, if you have any questions, absolutely reach out to us. You can give us a call. Our number is 562-896-2456. Or if you go to our website, which is showmehome.com, there's a contact us on there, and you can email us, or you can find us on social media, on Instagram or on Facebook. So any of those will work to contact Brad and I, and we are happy to put you in touch as well with the panelists here or with someone else who can answer your questions if you have a question that we can't answer. So thank you again to Julie and Micah and Brad and Kevin and Merrill. It's been a pleasure having you on here. And we look forward to continuing to work with you all. And thanks again to everyone who joined us. And we wish you success with your investments, both those current and those in the future. And let us know how we can help. Thank you.
Thanks, everyone.
Thank you.
Bye.
Thanks, guys.
Thank you.
Appreciate it. Have a good evening.
Bye-bye.